You'll hear people in business circles say that cash is the lifeblood of a business, and that is true. This is because majority of the business transactions require to be settled in cash. As such, an entity must maintain a healthy liquidity position. In this video, you'll learn about the statement of cash flows, a statement that helps users assess the entity's ability to generate cash. Hello and welcome to the accounting feed. My name is Philan and I'm your host for this session. Statement of cash flows can be described as a summary of cash inflows and cash outflows for a particular period, typically 1 year. Since it simply records monies into and out of the bank account, it is seen as a more objective and less biased statement. As such, we can say that this statement is verifiable in nature. The statement is prepared for the following reasons. Number 1. To assess the entity's ability to generate cash flows. Number 2. To assess the entity's ability to meet its short-term obligations when they fall due. Number 3. To identify the trends in cash flow components and cash flow consequences of investing and financing decisions. Number 4. To support management decisions regarding issues like financing policy, dividend policy, and investment. Generally, cash flows are classified into 3. Number 1. Cash flows from operating activities. These are cash flows generated from the principal revenue-generating activities of the business. These include cash received from customers, cash paid to the suppliers of goods and services, and finally, cash paid to and on behalf of employees. The second category is cash flows from investing activities. These are cash inflows and outflows from activities that involve non-current assets such as cash paid to acquire tangible and intangible non-current assets, cash received on disposal of tangible and intangible non-current assets, cash paid to acquire financial assets such as trade investments, cash paid to acquire subsidiaries, joint ventures, and associates, dividend received on investment in shares, cash received on disposal of trade investments, subsidiaries, joint ventures, and associates. The third and final source of cash flows is cash flow from financing activities. These are cash flows that relate to raising and maintaining capital. Capital in this context refers to long-term sources of funds such as equity, preference shares, and loan notes. In essence, financing activities are those activities that will lead to either increase or decrease in shareholders' funds and long-term liabilities. Examples of such include proceeds from issue of shares, repayment or redemption of loan stocks or debentures, capital repayment on leases, lease charges paid, dividends paid. Having discussed this, let's now proceed to methods of preparing the statement of cash flows. There are two acceptable methods of preparing this statement, namely direct method and indirect method. The difference between these two methods is how to determine the cash flows from operating activities. Everything else is exactly the same. Now let's start with direct method. This method requires an extensive use of control accounts. For more on control accounts, please follow this link. To get the cash flows from operations, you'll need to calculate 1. Cash received from customers. This is determined by preparing the receivables control account. Number 2. Cash paid to suppliers. This is determined by preparing payables control account. Number 3. Cash paid to and on behalf of employees. This is determined by preparing wages control account. This can also be calculated by breaking down the expense categories in order to remain with the amounts paid to and on behalf of employees. As this is an expense, it will typically be included in the administrative and distribution expenses. Therefore, to break it down, we start by summing up the two expenses, then deducting non-cash incomes and expenses which may have been included there. These may include depreciation, amortization, impairment, gain or loss on disposal, receivables expenses. If we put this in a format, it will look like this. As you can see, we are adding distribution and administrative expenses, so we have the total, and then we deduct those items such as depreciation, amortization, impairment, loss on disposals, and we add gain on disposal. The reason we are adding gain on disposal is because it had been netted off against these expenses. The other expenses had been added to make up the total of administrative and distribution expenses. The overall net figure that we get now is salaries and wages paid, which is equivalent to the cash paid to and on behalf of employees. Now let's put this in a pro forma, and it will look like this. Accounting feed statement of cash flows for the year ended 31st of December 2021. Cash received from customers. Then we deduct cash paid to suppliers of goods and services. And we also deduct cash paid to and on behalf of employees. Now this will give us the cash flows from operations. From this point going forward, the statement of cash flows in both methods is exactly the same. But then let's move on to indirect method. Unlike direct method, where cash flows are determined directly using the control accounts, indirect method starts with profit before tax, and this is to be adjusted to the following items. Number 1, non-cash incomes. These include things such as gain on disposal of non-current assets. Number 2, non-cash expenses. These include things like depreciation, amortization, loss on disposal of non-current assets, and impairment losses. Thirdly, incorrectly classified items. These are items that have been included in calculating profit before tax, but are either investing activities, such as investment income, or items used to determine the net cash flow from operating activities, such as interest charged. Once this is done, we'll now calculate the working capital changes. In this case, we simply determine the increase or decrease in inventory, receivables, and payables. These can be represented in the following format. Accounting feed statement of cash flows for the year ended 31st of December 2021. So as you can see, we start with profit before tax, and this is to be adjusted for all those items of expenses that had been deducted will now be added back. And what are we looking at? Finance costs, loss on disposals, depreciation, amortization, impairment. But then again, those items that had been added will now be deducted. Investment income, gain on disposal of non-current assets. We also have things like share of associates profit, which would have been added, so we take it out. This takes us to working capital changes. Inventory, increase or decrease, we put it there. Receivables, increase or decrease, the same thing. And payables, increase or decrease, exactly the same thing. When we net off these figures, starting from profit before tax and making adjustments to it, including working capital changes, we end up with cash flows from operations, which is the exact same figure as we got using the direct method. When making the adjustments, please note the following. 1. For items in the statement of profit or loss, whatever had been added as income will have to be deducted, and whatever had been deducted will have to be added back. This is why you can see that the gain on disposal, which is an income in the statement of profit or loss, is being deducted. The opposite is true for loss on disposal. As for working capital changes, increase in assets represent an outflow and decrease represent an inflow. In the same vein, increase in liabilities represent an inflow and decrease in liabilities an outflow. For instance, increase in inventory means that we purchased new inventory during the year, and that means we paid, so our cash flows reduced. A decrease means we sold them, hence inflow. A decrease in receivables means that we received cash from our credit customers, and therefore it is an inflow. An increase, however, means that we sold more goods on credit to our customers, and that represents an outflow. A decrease in payables means that we paid our credit suppliers, hence outflow. And an increase means we purchased more goods from our suppliers on credit, and therefore we have their money, that is an inflow. A full extract of the statement of cash flows will look like this. So as you can see, I have operating activities there, I have investing activities, and I have financing activities. The final thing that you need to understand is that once you net off all the cash flows from operating activities, investing activities, and financing activities, what you get is called cash and cash equivalents for the year. It should be that if we add the cash and cash equivalents at the beginning of the year to this figure, we should get the cash and cash equivalents at the end of the year. And this will usually confirm if all your figures are correct. Now, cash and cash equivalents will include items such as cash at bank, cash in hand, overdraft, and short-term investments. So in this case, therefore, you take cash in hand plus cash at bank, deduct overdraft, and then we add short-term investments. This marks the end of our session today. Thank you for watching. The fact that you're here now means that you're interested in accounting and finance topics. Please do not leave here before subscribing. It matters a lot to this channel. If you have any questions on this topic or on the area of accounting generally, and you'd like us to do a video on them, please post it in the comment section below. Don't forget to share this video and this channel to anyone you know might be interested. And until the next one, cheers!